Welcome back to our intermediate financial accounting class. In our last few segments, we've been talking about lessee accounting. We've talked about why leases are important. We've talked about how lessees are supposed to record their leases, and we've been doing the journal entries for those leases. And when we finished last time, we'd done the amortization table, the year 1 and year 2 journal entries, and I asked you to do the year 3 entries before starting this video. So hopefully you've done them. If not, stop here, take a minute, get them done so that you've tried it before we show the numbers. Now that you've tried them, let's take a look at these numbers. First off, we'll look at our finance lease style. Again, this probably isn't the way that Hanford would have to record the lease, but just for the sake of practice, we're doing them anyway. That, and of course, we just love journal entries. But there's our basic payment on January 1. Nothing really fancy there. Lease liability gets debited, cash comes out. We're making our payment. On December 31st, we record a year's worth of interest, now $27.06, right from our table. And then our amortization expense and accumulated amortization, they match what we've been doing in all of our other journal entries since it's straight line. If it's an operating lease, there's the same payment information. Nothing changes up there. On December 31, same exact amount of lease expense. Now we get the $27.06 to the lease liability, and the balance goes to accumulated amortization. So very similar entries. Hopefully you felt comfortable making that set of entries. Again, the real secret here is just pulling the numbers right out of that amortization table. And with that, we're going to do one last set of entries. That's for year 4. Believe it or not, that says year. I guess I'm abbreviating too quickly here. But let's start with our finance lease again. We've got a lease liability that we're paying off. On 12/31, I don't have any more interest that's accrued because back on January 1, I paid off the last of my lease liability. If the liability is at 0, there's no interest to accrue, so I don't have any interest expense. But I do still have amortization expense because I have used it for a year, and that's going to be the same amount. And now that we're to the end of year 4, I have to give this asset back. So the last thing I need to do, and this is my step 4, is I have to get rid of this asset. So I'm going to credit my right of use asset. Oh, this is depreciation expense on lease. There we go. Don't leave the journal entry naked, Jason. Really not cool. All right, we're going to credit our right of use asset for whatever we debited into it. And if you go back and look at our original entry, you can see that we debited in $226,574. That's also the amount that's in our accumulated amortization. You can see it down here in our calculation. We calculated our amortization expense so that it would match that $226, but you can also add it up, the $56,644 here, plus the $56,644 there, plus the $56,644 here, plus the $56,644 there. They all add up to that same $226,574. This is to return leased asset to the lessor. And because of the way I did my journal entries, there's no debits or credits to a gain or loss. There's just, I bought this asset with a lease, I've used it all up, and it's gone because I gave it back. So that's our finance lease. Operating lease is slightly different. Again, we have a debit to lease liability and a credit to cash for our final payment on our lease, $56,825. On December 31st, we record our lease expense again Same number we've used every other time, but we don't have any interest expense because I paid off all of the lease liability back with that January 1 payment. So all of it goes to accumulated amortization. 6575. This is to record amortization or depreciation on leased asset. Just like we had to do with the finance lease, we got to get this off our books. It's not ours anymore. So let's figure this out. We're still going to get rid of our right of use asset. And we recorded it for the same amount with an operating lease as we did for the finance lease. So that number is the same. And we need to get rid of our accumulated amortization. And because of the way we've done that calculation, it should add up. So do the calculation with me. Take the 60,575 right here, plus the 57,869 right there, plus the 55,292, plus the 52,838. And if you add all of that up, you get 226,574. Which means, again, I don't record any gain or loss, just the return of the asset to the lessor. Whether it's financing or operating, the system is set up so that we don't have to do anything special at the end. We've already depreciated or amortized it all away. It's ready to go. Now, there are a couple of exceptions to this. If I have a bargain purchase option or a transfer of ownership, meaning at the end of the lease I just keep it, then I haven't depreciated it over the life of the lease, but I'm depreciating it over the life of the actual asset. It's normal economic life. I do the same thing if I just intend to buy it, even without a bargain purchase option. I intend to do this. Well, in that case, whatever I end up with, I depreciate it for 4 years. I add up whatever amortization I have done. I credit away the right of use asset. I debit away the accumulated amortization, and I debit equipment because I'm transferring it out of the leased category into normal PP&E. Now, there is one other option that's a guaranteed residual. We'll talk about that one in more detail later, but just be aware that also is not going to come out so pretty. It's going to have an extra little step in it. Now that wraps up our discussion of lessee accounting, at least the basics. When we come back, we'll start talking about the lessor and how those journal entries work. So more fun journal entries and amortization schedules to come. We'll see you then. Thanks.